Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have David Skarica on the show. David is an investor, speculator, and technical trader, and also the host of a YouTube channel called Stock Chart of the Day. David, thank you for coming on the show.
Yeah. By the way, I like the name of your site. Because I also run something called Addicted to Profits. So I like the fact that it's a little tongue in cheek and not serious, which I think sometimes the stuff can get too serious.
Yeah, this used to be a poker show, and then when we transitioned to investing, we put it out to the hive and got a whole bunch of submissions, and the one that won out was In It to Win It. So I think it's pretty appropriate. I like it a lot.
Yeah, I like that too. Yeah.
Yeah, go ahead and start out by this is your first time on the show. Give us a couple minutes on your background and how you got into investing and speculating.
Well, like, even though I'm not that old of a guy for this industry, I'm 46. And I got long hair. But I started really young. So I've been doing this for almost 30 years. I started when I was 18. When I was 18, I was the youngest person in Canadian history to get their securities license. So I got that when I was 18 years old. Then my first book, Stock Market Panic, you can find it's actually under Dave Skarica on Amazon, not David. But anyhow, I had that published in the 98, and that was kind of about how stocks were overvalued and going to see a big bear market, and gold and precious metals were undervalued. I finished second about 20 years ago. I think it was 2003 in the Globe and Mail stock picking contest. And I know you're talking about the names. When I started Addicted to Profits in 1998, I was a big Robert Palmer fan. So that's why I called it Addicted to Profits, kind of named after his song. So, yeah. And then, so since then, I've written it for 20 years. I've kind of morphed more into consulting and raising money for companies as my main form of income, because I can make so much more money on that than in the newsletter industry. I think, isn't the greatest. It hasn't been the greatest for years. So that's kind of what I, morphed it into since then. And we've had some junior deals since 2019 that did really well. Obviously, the junior market's been pretty garbage the last 2 years. It's been tough, but actually I've done a battery storage deal recently. It's done really well. It's up over 7 times the value in just the last couple months. So, that's the kind of stuff we do. And I mix it within, I've always had this interest in gold and precious metals. The first book I ever read was when I was 16 years old, was The Great Reckoning by James Dale Davidson, which was about how, governments had too much debt and, blah, blah, you want to put your money into hard assets. So I've always kind of been fascinated from gold. I am Canadian. And of course, we have a big mining sector there. So that probably also made me more open to gold and precious metals than maybe than someone who's from, I don't know, Tennessee or something, And then, and then so I kind of mixed that, the precious metals, venture capital we also look for beaten up assets. So like in 2014, I talked about buying Japanese stocks. In 2012, we bought some Greek stocks because Greece had been battered. Actually, one of my best trades ever in 2009, I bought Tata Motors, which is the Indian, car company. They own BMW. Sorry, BMW. They own
Jaguar?
Jaguar and Land Rover. Yeah. Sorry. And so anyhow, and one reason I've changed it into the stock chart of the day, which is kind of more educational, more talking macro from a paid newsletter, is that because when you have this investment philosophy of buying these beaten up assets, sometimes you have to wait years for the right opportunity. And I don't think a monthly pay subscription, even though I have a Patreon, which I consider almost more a donation than a subscription, is it's very difficult, because I might just say, I'm not going to chase NVIDIA, I'm not going to chase Microsoft or whatever it may be. And at the moment, but you got to wait for these beaten up assets. And sometimes when the markets are overvalued, it can take years. Like usually once every year or two, an opportunity in any market around the world presents itself. Like I said, 2009 was the entire market. 2012, you had Greece. 2014, you had Russian stocks. 2015, you had resources. 2020, you had a lot of beaten up, actually oil and gas, energy. So usually every few years, something presents itself. And there's actually a study done. I don't know if you know a guy named Maybain Faber. He runs a group of funds, and he just showed what happens to an asset class in the study, that when it's down 70, 80, or 90%. Yeah, and the 3-year returns are always in the triple digits usually. Now, sometimes that doesn't happen right away. Sometimes you may not make no money for a year or two. Like That's what's happened in junior minors for the last year or two. But usually at some point within that 3 to 5 year period, and if you can make 100% in 5 years, you should be pretty happy,
Yeah.
So yeah,
Yeah.
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 And
Every
that's a bit about me. And also, as I said, I'm Canadian. In 2005, I relocated. I live in the Bahamas now. And if everyone wants to have a good laugh, we're talking about not taking ourselves too seriously. If you type in like Bahamas refugee Barstool, I did some videos from Barstool with them in 2020, and it's right before COVID happened, and they're hilarious. They're not serious investment videos, just so you know. They're a lot of fun. So if you want to, you want to see that, and and if anyone comes, I live in Eleuthera. Anyone wants to come to Eleuthera and hang out and have a few drinks, yeah, no problem, man. So it's not a dry island, so.
Awesome. So you've been doing this for almost 30 years. You published your first book when you were 20, I guess.
21. Oh, yeah, it was actually like a month before my 21st birthday. Yeah. So
congratulations, man. That's quite a run. And you were the youngest guy to get approved in the
sure, yeah, I didn't even go to university. I decided to start my business right after high school. And luckily my dad was really supportive, right? And like he was just like, well, this is the money that would be for your tuition, but let's help you out in your business as long as you're not a bum sitting around, smoking weed all day. And, so which can happen when you're 19 or 20 years old, or So no, I was like kind of a dork. I was a nerd. I was just like all into investing and running the newsletter, and like I said, and that sort of thing. Yeah. And then I just like slowly I started doing the speaking tour in the early 2000s. And then it just led to like, I don't know how, but just I started doing I lived near Toronto at the time. So I did the BNN thing for a while, which is the Canadian CNBC basically. And then in 2008, it's this kind of funny story because we're talking about maximum pessimism. At John Templeton's memorial, I end up sitting next to this guy named Christopher Ruddy. I don't know if people don't know who he is. He is the CEO of Newsmax, the large, news company. And we hit it off. And then he got me actually a book called The Great Supercycle, a major publishing deal with Wiley. So I got that. And then I wrote it. I still write for Financial Intelligence Report, which is one of their publications. And I've done it for 14 years, since 2009. So actually 15 years now. But yeah. So that it was just pure luck. He sat right next to me at the memorial service, and we kind of hit it off. And that was, like I said, that was 2008. So now I'm feeling old. That was 16 years ago. But yeah. So that's a bit about me. Like basically my philosophy too, and you're talking about in it to win it, is 90% of the time when you're doing venture capital or these plays, to be honest, it's not going to work out that great. You're going to make no money. You're going to lose a little bit of money. You make a little bit of money, but that 10%, you're going to have these 5, 10, 20, 30, 40x type deals. And that's what makes it. And dude, I'm telling you, even if you read what Warren Buffett has said, or John Templeton used to say, they will say that. Like no one talks about that with them. They'll say, really, all you need is 5 deals your whole life like that, and you're set, So the issue, again, I have with writing a book, with newsletters, 90% of the stuff's not going to work out. That's difficult because how many people are actually going to be in the 10% of stuff that does, like this little company I raised money for, or helped raise money for, at 5 cents. I only got a handful of people in it because it was totally beaten up and no one wanted to touch it. Well, that's the stuff that usually does the best, right?
Yeah.
So, yeah. And then when the market's hot, people will be wanting to buy, gold private placements at 50 cents or $1. And I'm like, well, you might make 50 or 100% on this, but the time to buy them was when all these deals were 5 or 10 cents,
Yeah, the time was 2 years ago when I was telling you about it.
Yeah. But we'll get into uranium, but you said Cameco you bought 2 years ago. So yeah.
What okay, let's move on to the big picture view. You've kind of touched on it a little bit already, but what is your macro view of the US economy and financial markets?
Like, I'm somewhat bearish on the economy. I do think we might have a mild recession, but I'm more bearish a few years out. I think we're everyone thinks that right now, if they cut interest rates like '01 or 2008, everything's going to collapse. But back then we were in the dot-com bust. The housing bust was already well underway by 2008, right? Like housing prices peaked in 2006, and in 2007, all the subprime lenders went under. So, okay, now we are seeing some warning signs in the regional banks and that sort of thing. But for the most part, we're not really seeing it, huge like economic downturn. And part of the reason I think the COVID money lasted for a while, and now with inflation slowing down, and I do think we're gonna have another inflation spike at some point, but you're still seeing wage gains. and the inflation is coming down. So even though people are just making up for the lost real wage gains over the last 3 years, they feel richer in the shorter term, right? That's the ironic thing. They feel like, oh, I'm making 5% more a year and inflation's 3%, right? Where like when it was 8%, they were still only making 2% more a year because I had to catch up to inflation. So say over the last, since inflation really picked up in say 2021, say over that last 3-4 years, inflation's up cumulatively, I don't know, 25 to 30%. I'm using their numbers, which we all know they underreport. But anyhow, people's wage gains are probably 15 to 20. But the fact that like now they're making 5 or 6 and inflation's come down makes them feel richer. So I think the economy isn't terrible. And to me, it looks more like a normal rate cut cycle. 1995, 2019, where they cut rates and the market sees like a moderate rally. And then there could be a mild recession, but I really think that when they cut rates, you'll see this resurgence inflation probably in 2025, 2026. And that is when, what can hit the fan because with debt so much higher now and costs so much higher now, if those rates on the next cycle, this time that the bond peaked around 5%, if it goes to 7-8%, the government can't really handle that with these debt loads. It's not like the 70s when debt to GDP was 40%. Now it's, going to be close to 140% in 2 years. So they can't handle that. So that's why Japan can't have rates go to 2 or 3% because at their debt, they'll basically be insolvent. So I think really the next cycle is when you're going to see that. And also, if you look at inflation cycles, like if you look at the 40s and the 70s, which were the last 2 major inflation cycles, usually it's not just one spike. There's like right now we're going through the lull. This is kind of what happened in 76 or the early 70s. I don't know which phase we're in. If we're entering the late 70s or we're entering that 73, 74 spike. But there's about 3 spikes in inflation, and we've only seen the first one. So I think there'll still be a few more. And again, if you want a really long-term macro view, and like 2030 to 2035, all the baby boomers are retiring, right? So Medicaid, Medicare, Social Security, I'm from Canada, Canadian pension plan, healthcare costs are going to go through the roof. And government, Paul, they're not going to cut spending. They're not going to say, okay, sorry, Medicare is done because, we can't afford it. They're going to print money to pay for it, So the only way governments cut spending is when they end up like Argentina, when they've been so bankrupt for so long, people finally give up and say, hey, we need this kind of more radical type guy in to really change things. But I don't think in the Western world, especially in the socially democratic Western world with all these, welfare programs, we're anywhere close to that philosophy. They're that.
Yeah. Okay. So you see bearish for probably a few years out. The COVID STEMI checks that were printed are kind of having a little bit longer lasting effect than I think most people are accounting for. And one thing you said too about all the unfunded liabilities. I mean, the last numbers I saw, it was like 34 trillion in debt, and then unfunded liabilities, I think, was on the tune of like 120 trillion. And it's like, that's one of the reasons that we started this show was it's like, you shouldn't have to depend on the government for your retirement. That's your responsibility, and why not invest in a company that is solvent like Exxon and simply get paid for the next 30 years in the form of amazing dividends and capital appreciation, totally. Instead of requiring the government to send you a Social Security check that is completely insolvent in the long run,
And by the way, I do that in the paid version, the Patreon version of my publication as well. We recently just added an Argentinian company that's paying like a 15% dividend. I added Altria, which used to be Philip Morris, which pays about 8 or 9%. I haven't done it yet, but I'm kind of looking at 3M because it hasn't done very well, but it's yielding near 6%. So that I look at like these long-term dividend plays because ultimately what I want to do, like I said, I'm a younger guy. Luckily, I paid off my house 3 years ago. And now when I build even more savings, I want to take, like if I do a venture capital deal and hopefully make a lot of money on it, 50% of what I make, because one reason I live in the Bahamas is that's our income tax level, right? Is 0, So one reason is I want to put half my money in just these dividend companies, and I won't even care about the price fluctuation so much. It's just like if I have $2 million, say, in a bunch of dividend plays that yield 10%, it's like you make 200 grand a year and that you can just live off that, right? You can also
Yeah.
reinvest the dividends and do that, but you have enough just to kind of live off of without having to kind of worry about, your day-to-day income or the whatnot. So, no, I totally agree with that. And also, even though we're going to get into gold and precious metals, stocks are inflation hedges too. Go look at the MERV, which is the Argentinian stock market. It has gone like straight up, in the last 5 years, because that's a way for, especially if the domestic population can't get US dollars or gold or whatever, they can just buy the Argentinian stocks. And in the local currency, it's basically keeping track or keeping pace with inflation. If you look at all those hyperinflations in South America back in the 80s, or the Weimar Republic, the stock market goes up gigantic because it's another inflation hedge. It's like an ass, and it's again another way that inflation kills poor people because they live off their incomes, but rich people own all the assets. So housing, uh, you know, uh, um, stocks, gold, these things all go higher during inflationary cycles. Like I don't. You're out. Where are you located?
California.
California, yeah, and you know what the cost of living there is. Like even here in the Bahamas, I think my house has tripled in price because I see what stuff is sold around
Wow.
me in the last 11 years. Because also this island is smaller and it became more desirable. Like actually, the New York Times and Wall Street Journal just did articles on the island in the last couple months, right? So it's become more desirable, especially after COVID. People wanting to get away. Obviously, there's more violence in these cities, especially these liberal cities in the U.S. So, but anyhow, all these things are like inflation hedges, like real assets,
Yeah.
So, and a funny thing is I never even looked at my house as investment. I was like, I just want a house that I want to own for myself. That was the
Yeah.
way. Yeah. So
Yeah. Okay. I'm going to share my screen here real quick and take a look. This is the CME Fed Watch tool. I'm sure you're
yeah,
familiar with this one. And okay, so the next meeting in March, this has gone up a little bit. So 89%, we'll call it 90,
yeah.
think that the Fed is going to pause. Then we go out to May here. And just a little while ago, most traders thought that they were going to cut their first 25 basis points here. Now, most of them think that they're going to continue to pause. And then it's not until June that most traders believe that that's when they're going to start their first initial rate cut.
Yeah, and that
What do you see with this?
28%, yeah, that 28% is like that's a combination where that's still a price in from a May cut, right? So like that's kind of like that 20% is really a chance of two cuts by June, right? So yeah, no, it looks like it's pushed back till June. And here's another factor I want people to listen to though. This is the irony. I think the less rate cuts they do, say they do 3 or 4 instead of 6 or 7, that's actually probably more bullish. And the reason being is if they're doing 6, 7, 8 rate cuts, it's because it's probably a bad recession, right? Where again, if you look at 1995, and you could just put up the IRX, like a 30-year chart up on stockcharts.com, you'll see they raised rates a ton in 94 and they only did 3 25 basis point rate cuts in 95, and the stock market went absolutely insane. Like before COVID and rates went to zero in 2020, they'd only done a couple rate cuts in 2019, and the stock market in 2019 was rip roaring, right? So if they're just,
Can you bring up that chart?
yeah, are you allowed did you allow me to screen share?
Yeah.
Oh, perfect. Actually, this chart is interesting for two reasons. Okay.
Mhm.
Number one, we're looking at this here right now. You can see the 94, 95 situation I told you about,
Mhm.
where there was this big thing. So this is basically tracking the Fed funds rate, the 3-month treasury. So it goes from 2.5% at the end of 93 to 5.75. So it went up over 300 basis points. And you can see in 95, the cuts were pretty small. We went to 5%, and then it basically stayed there for most of the next, 96, 97, 98 until they cut rates a few times during the Russian crisis. So that's what I'm trying to show you. And again, you can kind of see in 2019, after we went from 0 to about 2.5% on the short-term bonds, you can see that, it slowly went down to about 1.5%. Again, I think they cut about 75 basis points. And then it went to 0 when everything collapsed during COVID, right? So what's interesting is, and again, go look how steep the rate cuts were in 01, 08. So the two times in the last 30 plus years when we kind of had these small rate cuts, we had, it was again 95, 2019, and the markets are great. And the two times we saw these really steep rate cuts, we had recessions and bad bear markets. So I don't see this only three rate cuts as okay, maybe short term, the market's going to have some tantrums. Short term, the market's very overbought too. So maybe that will continue. But like, I just see that if we're going to only have the 3, 4 rate cuts, it's probably a sign that, we're going to get the soft landing or a mild recession. And then, we won't see, the rates go up till 2025, 2026. And that's when we could see a big downturn. And also, let's think about the last few years. 2020, 2021, we saw this huge boom in the stock market after, the COVID crash. And then 2022, we saw a very poor year with very steep, rate increases. So it kind of seems to me we're almost back to the normal, the don't fight the Fed, as Martin Zweig used to call it back in the 70s, 80s, where the market is more trading negatively when the Fed is tightening and positively when the Fed is loosening. Because one reason the market did well last year was it was becoming obvious by, the spring or the summer, hey, you know what? We're almost done these rate cuts, or sorry, rate hikes. And the market kind of start anticipating. One thing too, we have to understand too, is they used to do surprise rate hikes and surprise meetings. They really don't do that anymore. Okay, there's a crisis like 2020.
Yeah, they forecast a lot.
Yeah, they forecast a lot more now, I think, to not shock. And they, on the upside, they forecast a lot. Remember, in 2022, inflation was already 8%, right about the time of the Russian invasion, in the spring of that year.
Mhm.
And you're talking like the spring of 2022 that occurred, and like rates were zero. I remember at the time they were still doing QE in March of 2022 when inflation was hitting 8%. That was like the last of the QE that came off. So they were way behind the curve because they did not want to shock the market. Because I remember I made the comment in 2022, that late spring, like May, June. I was like, look, they should just raise rates to 3% overnight because inflation's 8%. It's ridiculous that we still have these rates at 0.5%, 0.75%. But again, they don't want to shock the markets, especially when they're raising.
So what you're saying here, if I understand you, so going back to 1990, when it's going down, this IRX is, I'm not familiar with this one. This is essentially following the 3-month yield, I guess.
Yeah, this is the 3-month treasury, which essentially tracks the Fed funds rate. What you showed
okay.
earlier. So it's basically tracking it's tracking what they're doing. So one thing that's interesting now, if we were to get I'll get it's like a shorter term chart. I'll just get like a chart that's a year old. You'll see it's actually coming down a bit. It's been coming down since October.
Yeah.
And that's kind of like a sign that they've stopped. They're basically the rate hikes are done, right?
Okay.
That we're trading between five. It's basically times or minus that, like that the 5220 is 5.22%, right? That's essentially what it is. So yeah, I use this because I don't think on stock charts they put the Fed funds rate. So I use this just to show people. But here's one thing I want to show you. It's interesting with this long-term chart, and I'm going to go all the way back to 1980 when the long-term bull market and bonds, bear market and yields are going down. Notice that all of these peaks, like that was the peak in 81, and then 84, 87, 2000, almost every one of these peaks, like there was like all these lower lows.
Yeah.
This is the first time we've seen a higher high.
I noticed that same thing too. I thought they were going to stop at like 3% to keep that trend line, but I was
more
off.
hawkish. I just thought with inflation, the worst since the 70s, they would have to go 4 to 5. They even went higher than I thought, and I was more hawkish than most people. But I think this is the sign that we are starting the long-term trend in interest rates. Interest rate cycles are very long, guys. Like bonds peaked in 49 and they bottomed in 81. So the yields bottomed in 49, and that's 32 years. This last one was 40 years, right?
Yeah.
1981 to 2021. So the bond cycles are very long, but nothing goes straight up. So I look at it this way: it's like they've gone from 0 to say 5.5. So maybe we go down to 3-4%, whatever it may be on this next move, but it's a cyclical move. And then we're going to see higher highs because I think we're going to have a debt crisis ultimately. Like
Yeah.
actually, to go back, like how I got started in this, the first book I actually read was actually not The Great Reckoning. I was wrong. It was actually Harry J. Figge wrote Bankruptcy 1995, and he published that in 1993. You can go buy a used copy on Amazon for like, $1 now. And he talked about the debt going out of control and they're going to see a debt crisis. And what's funny is the debt has gone up faster over the next 30 years than he predicted. I think he's passed away now. But he never anticipated interest rates would go to zero, which is obviously common sense. Like you think if the debt goes from 4 trillion to 34 trillion, rates are going to go up. But rates went from like 7%, look at 93 when he wrote it, or whatever, 7%, to zero. Like no one would have ever anticipated that. And one thing I'll say about the powers that be, and this is where I've been wrong in the past, they're good, man. Quantitative easing, ZERP, all these fancy names that they call, it's just basically all money printing,
Bank
right?
term funding program, yes.
yeah, man. I gotta say, man, they're cagey. They know how to package this stuff and call it like sophisticated, Ivy League crap, basically,
Yep.
So.
Okay, so basically, maybe you have a chart for this. I could pull something up. What do you see happening, and what have we seen? History doesn't repeat, but it often rhymes. When the Fed starts to cut rates, what do you expect for the precious metals during that?
Okay, so I'll show you right now. It's funny because we have this chart. So I'll just get like the XAU because the HUI doesn't go back because
Yeah,
it's
so
far.
this is gold. Yeah.
Yeah, this is gold. So we can see when some of these rates, what I'll do is below it, instead of the MACD, I'll put that IRX so we can see the rate cut cycles, So what you can see here is that like, okay, when they start to cut like 84, you can see like this goes from 70 to 150. My gold stock's more than doubled, right?
Yeah.
Again, 90, you can see like 92, 93, 91, 90. It started. Okay, there's an initial big move. And then, you can see here, and again, 70 to again, more than double. In 2000, 2001, when they started to cut during the dot-com bust, that, by the way, was the ultimate gold bull dream. Stock market's going down and they're cutting rates, and during a bear market, gold stocks are going crazy, right? And you can see this is, it 40, and it's eventually went to, over 200, and everything crashed in 08. And again, when they started doing the ZERP and zero interest rates, we again went from like, just over 60 to 220. And then that 2019 cycle I talked about, they started to cut rates, and it went from, 60 to 160. And then in 2020, again, you can see again, let's consider that all as part of the same cycle, because the 2020 crash in gold stocks, just came right back.
That was an anomaly when
that was an anomaly. So again, the gold stocks like tripled. And again, if you look at it's the first 12 to 24 months, what happens is as the bull market matures, people don't want gold and gold equities, right? They want tech stocks, high growth stuff. So they kind of get out of that, and then gold starts to lag. But in almost every single instance we can see here, when a rate cut cycle started, like even in 2007, before everything crashed together, this move here on gold and gold stocks, they doubled in that year. They were the best performing sector until we had just like everything sold off together, like a big mass liquidation in every asset. But it's like, so when they start these rate cut cycles, they really begin to move. And one analogy I'm using right now is, because we're also at a resistance level gold at 2100, is that it kind of reminds me of 2003. In 2003, the resistance was like 400, and it spiked to near that during the start of the Iraq invasion.
I got a chart for this right here. I'm gonna pull it up, and I'll pull it on.
If you can find the 2003,
So 2003 is around 400. I put 425, but yeah.
And I can see we think the same way from this, because this is exactly what I've been showing.
Okay.
Yeah. So and then 2008 it was 1,000, and then it was 1,400, like you're putting there. So what we can see is it came off the resistance, and then in the second half of 2003 it began to move higher. That's kind of where I think we are now. Okay. And that rally started in about April to May of 2003. And look at all these three resistance you put up. So gold went from, when it broke 425, it goes to 1,000. Right? And that became the new resistance. It breaks 1,000. It goes to 1,900. and then 1400 became the next resistance. It breaks that, goes to 2100. So all these moves are between 50 and 150%. You
Yeah.
know, so
Yeah.
I would just think that once we break that 2100, we're looking at 3000 to 4000 on the next move in gold. You know,
And another thing I'll put here is we can see that we have kind of a cup and handle, boom. And then we also kind of have a
cup and
cup
handle. Yeah,
and handle.
exactly.
And if the pattern holds, should be 2,500, 3,000, possibly north of that.
Yeah, and I think again, once those Fed rate cuts come more in, talking about those cycles, everything's kind of slated there for maybe this to break out, in, like I said, the second quarter of this year. That kind of, by April, May, it'll be like, okay, yeah, they are going to finally cut in June.
Yeah.
So I think that's what we can kind of see there. And I know it stinks because as a gold investor, you get impatient. You're like, oh, we're so close.
Yeah. You see what's going to happen. You're
Yeah, you can see what's
yeah.
going to happen, but you just like, and I do a lot of, I used to do, I actually, and I still do some, but I do a lot of options trading. And it's like, I gave up on that because I'm like, I don't know when this is going to happen. I rather just buy like look for the gold stocks that are cheap or ones I really think that can move. I do, again, a lot in venture capital. I've got a couple pre-IPO deals I did in juniors that I think will come out right when this breakout's happening.
Mhm.
So, that's the kind of the way I'm playing it,
Okay. Okay. Here's another chart. This is GDX versus gold. So basically, the lower on the chart here, the cheaper the gold stocks are compared to gold. And this goes back to what, '06. Here's GDXJ versus gold. So the lower on the chart.
And
And
you could do it with HUI if you want to go back longer, or even XAU. You can
okay,
get.
yeah, I pulled up the Huey here. I didn't pull it
Yep.
in relation to gold, but yeah, I mean we're at some pretty low. I mean, almost setting up a double bottom right here. It looks like it might have broken it a little bit,
And
but
when I was really starting to trade all this stuff 20, 25 years ago, I was really into, the gold stocks lead the metal. Well, I don't think that at all anymore. Now I just think that, right when they're cheap, like if you actually, one of the great stocks to buy compared to a metal right now, I don't, Endeavor Silver. I've
oh,
recently added that to my watch list. And the Endeavor to silver ratio is basically as cheap as it's ever been. Like it's where it was at the 2020 bottom, where it was in 2008, etc. So I think Endeavor is around $2 Canadian, which is like 150 US. And usually the low is around one. I don't know if we're going to get to one because I think silver would have to go quite a bit lower for that. But Endeavor is a very interesting leverage play. And then Endeavor's got this huge chart. If I don't know if you can show that as well, but it's got this huge range. I did this recently on one of my paid members updates. Like, where bottoms at that, like I said, that 1 to 150 level. And then it goes to like whatever, $5, $6, $7. So it's a nice trading vehicle too that, you can buy at 2 or 150 and then you make about, 3, 4x on your money. Usually it's within 12 months of that low too, or 24 months that Endeavor
Endeavor
will have.
Silver. There we go.
There it is. Yeah. You can see there was the big move in '09, but like, yeah, even these little moves after 2015, 2020, yeah, you got a nice 3, 4, 5x move in the stock. And you can see that spike. Like those
Yeah.
moves happen quite quickly in it.
Yeah, yeah. I've obviously pulled this one up before because I've already got drawings on it. But yeah, I see the same kind of like we got some wedge patterns or something going here.
Yeah.
Maybe even a bullish pennant. But yeah, I mean, man, you're right. Look at that. There's coming up on the. I haven't pulled
Yeah.
this up in a little bit, but I've been meaning to as it approaches this white line, and we're darn near there.
Yeah, like maybe like if you again you look at those bottoms in 2015 or even 2008 and the 2020, it looks like it spends a few months or a few weeks at least. So
Yeah,
maybe we need to go sideways in Endeavor, again till that spring period.
yeah,
But this is probably going to be a nice trading vehicle. And
yeah.
like you're showing those wedge patterns, like maybe some long-term options might be in the cards once it breaks that downtrend line.
Yeah, maybe like a 6 month option or something.
Yeah, or January 2025, you
Oh,
know.
even longer. Okay.
Yeah, even longer, like a leap.
Yeah,
So
yeah, yeah, yeah. Okay, I like that. I didn't think I'd get any trading ideas out of this, but I love it. Okay, where do you see for the dollar? What the you see it kind of grinding a little bit higher, hitting on some resistance. What do you think of
I
the
think in the
DXY?
short term, it could continue to rally.
Okay.
But again, these rate cuts are happening slower than people thought. But when I look at the other major currencies in it, especially the euro, which is basically the major currency in that dollar index,
Hmm.
uh, I think they're gonna in Europe, they're gonna keep rates higher a little longer. They're just like they raised a little later, they're gonna cut a little later. So that might help the euro once they finally start to cut. But yeah, that chart looks okay right now. It's not really, let's face it, strong in either direction. You've kind of been in, for over a year in this trading range,
Yeah.
but I could see it continue to move higher. I think one issue too in the dollar too is currencies like the Australian dollar, Canadian dollar. I think in the short term, oil is not going to do very much. There's an oversupply in oil. So that, in the Canadian dollar and Australian dollars have pretty strong correlations because they're natural resource based economies. So I think that, you could see the dollar continue that to kind of hold here, but I think once these rate cuts start, you're really going to see that. And the problem with saying, oh, the death of the dollar or whatever is, look at all these countries are screwed. Canada, Australia, most of the European countries in terms of the UK in terms of the amount of debt that they have. So it's just the question is, does the dollar go down faster than the rest of them? Because the one thing that can hurt the dollar is if you lose the reserve currency status, there'll be an exodus out of it at some
Yeah.
point, right? So
Yeah.
that actually that the thing that makes it strong can also ultimately make it weak, right? So I think that's one of the issues you're going to have. Yeah, I'm pretty neutral, I'd say right now, but I do think it would weaken if they do a rate cut, kind of cycle.
Okay. All right. So gold, we're basically waiting on the Fed to start cutting rates. Silver probably is going to follow that similar pattern, right?
Yeah, yeah. So actually, again, I don't know if you do the gold to silver ratio, but silver is still historically pretty cheap right now.
Yeah.
I personally would be buying silver here over gold, like
Yeah.
if you chose one of the two,
Okay.
And I talked about Endeavor, and that would mean probably the silver equities have more upside as well, you know. So so that's what I would be looking at. Yeah, the gold to silver ratio. So if you think gold is cheap, compared to other assets, well, then silver is cheap compared to gold. So you probably would want to get that in here. And then if you look at from the pure basic dumb math, math for dummies, silver is, almost 60% off its all-time high, and gold is, less, about 5%.
Yeah.
So, just to go back to the all-time high type deal, and silver tends to be a more spiky trade near the end of the moves. But yeah, you're probably looking at, like if silver were to break that support,
Hmm.
I think it would be a quick, reversal. So
Yeah.
you'd probably want to like, like the next support you'd probably want to buy,
Yeah.
you know.
Yeah. We
So
see the next, if it breaks this 22, which it's touched it. Now,
yeah.
what are we at right now? 22.40. The next one we see is like 21 bucks. Is that about what you
Yeah.
see?
Yeah, I would start. I think it's one of these things you just want to maybe slowly edge in. I think when you're looking at these long-term plays, you can never get the bottom. And it's like, all of us were, being precious metals bulls, we're hoping like, you see when silver hit those resistance levels, especially remember when there was that attack in the Middle East and everything gapped up on that Sunday night, right?
Yeah.
And I'm a big football fan, and I'm
Mhm.
sitting there watching football, and people were like writing me like, hey man, look at gold. And then I woke up the next morning and the big, huge reversal had happened. And I was like, never, ever write me again Sunday night when I'm watching football. Because that was a waste of time. you know.
Well, you mentioned oil here. What do you see with oil? We came off some pretty big highs back in 2022. This is when we exited a lot of our positions, and then now we've been scaling back in as we got down around the high 60s. We're sitting just south of 80 right now. What do you see for oil?
I don't know if you do seasonality trading, but there's a great website run by a friend of mine named Don Vialu. It's
Okay.
called equityclock.com. And he actually has a fund that trades in Canada that's based on seasonalities.
Huh.
And it's done pretty well. Like he makes 8-9% a year. It's a nice little actually conservative tool or ETF to own. But anyhow, basically early December is like almost always the low for oil, right?
Oh, okay. I did not
But
know that.
now the reason that we have not seen this huge move is there is a lot of oversupply right now. We haven't really seen, the decline in production in the US. Um, and we're seeing production staying at pretty stingy levels. And I think OPEC some wants to hurt the frackers, so they don't mind the lower prices. So maybe the weaker ones go out of business and the whatnot. But I think one thing that can really help oil is that I they're basically done. They sold a ton of the strategic oil reserve,
Yeah.
and I think they're basically done doing that. So whoever wins the presidency is going to start rebuilding that. And that's a buffer, like that's a buy for oil. I think actually they actually have started to buy a few million barrels, you know?
Okay.
So
Yeah.
yeah.
They
So I
they
think
drained that in an effort to keep the gas prices low
yeah, they were trying to win the midterms, but I was shocked. I thought, okay, last year they're not going to do it anymore, but they were still doing it last year, like after the midterms. And I think that was in an attempt to even keep prices low into the election. But I think they've drained it so much, and it's actually become a talking point. Both Kennedy and Trump have criticized them for doing it. It's just saying that they're inept. Like look what they're. You're only supposed to drain this if there's a war, if there's a crisis, and they're just doing it to like keep gas, oil at, $70 to keep gas prices down to get reelected, like
Yeah.
that's total BS, So, yeah.
How about, oops, I'm looking for natural gas futures. What is that? I thought it was NG1. No?
I just did a natural gas update. I'm a big bull right down at these levels.
Oh, okay.
Yeah. Again, natural gas is kind of similar to that Endeavor chart. It's
Yeah.
like, yeah. It's that level about the $2 level. That's when it's a buy, you know.
Yeah.
Almost every
Oops.
time when gas
There we
gets
go.
to $2. Now, some of the trades aren't so great. It goes to $3 to $4. Some of the trades, it goes, it spikes up a lot more, but this $2 or so level, like this is usually the low, as you can see, especially
I mean,
going
this
back.
is going back to the 90s, and if you
Yeah.
just bought on that white line and held for a little bit, you usually did pretty well.
Yeah. So it's tough because costs have come down for a lot of these natural gas companies
Yeah.
because of the fracking boom. So that's one reason, like you're not seeing those prices of the 2000s again, when it went to 13, $14. But definitely down here, you're going to see less drilling. You're going to see less whatnot. The company I bought is Enbridge, which is more of like a pipeline company.
Yeah.
But of course, they get it, when they're shipping it, they get a cut, and the cut they're getting is bigger when natural gas is $8 over when it's $2. So and they have this dividend they paid forever. It's more of like a conservative play on it. There's something called Devon Energy you could look at.
Oh, yeah,
That's
we got Devon. Yeah.
Yeah, Devon's more of a leverage play. But like if you're looking for Devon pays a nice dividend, but they cut the dividend a lot when natural gas prices fall. But
Okay.
again, I think Devon went to $5 during the COVID lows in 2020, and then it rallied to 70, and now it's like $40. You
Yeah.
know,
Yeah.
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 But
And
it's come up pretty good. It's come from 70 to 40.
here's
See,
Devon.
the thing about stuff like this is like with Devon and the whatnot, it's like, look, the reason it went to $5, a part of the reason wasn't just natural gas, it's because the whole market collapsed, in March of 2020.
Yeah.
It had been falling for a while anyhow. But like, so for Devon to get back to say 20 or something like that, you'd probably need a pretty severe correction in the stock market for that to happen.
Yeah. Okay.
So
Okay. All right. Okay. Yeah. And there's quite an arbitrage on natural gas right now. I mean, especially if it sticks around south of $2. It's not a whole lot to ship this stuff across the Atlantic. And
well,
last I heard, Japan's paying like $8 or $9 a million BTUs for this. So it's
Well, that's why LNG, Cheniere or whatever, they've done so well because they're a liquefied, basically natural gas play, and they can. That's what they do, right? They liquefy it, and then yeah. If you go look what Germany's been paying ever since they can't ship it in the Russian pipeline, like it's 3-4 times above the market price, right?
yeah.
You know, that's what great allies we are. We tell them to stop buying Russian stuff, and then we sell it to them at a huge markup.
And then we blow up their artery so that they can't even get it if they wanted to.
Well, and then Biden, as a reaction, and I don't want to get political, but as a reaction to what's going on in Texas at the border, he then tries to outlaw, LNG exports, because it hurts that industry. But what's that do to Germany? Like,
Yes. Okay, real quick, let's touch on uranium. Do you have any opinion on uranium?
I think uranium's a long-term play. Like you obviously have a lot of countries like UK is really building a lot of reactors. Obviously, the big ones are China and India are really expanding nuclear power. I think realistically, if you want to go green, it's not going to be wind and solar. It's going to be nuclear that really does it.
Yeah.
So longer term, I like it. Obviously there's Cameco. There's some other smaller producers. The issue with uranium is, and we talked about this off the air, the juniors are really not very good companies. So and that's been the case since the uranium boom of 2005, 2006. So I think I'm kind of conservative with uranium. It's just like, buy Cameco or something. I don't buy it here because it's gone up a lot. You said you bought it a few years ago, but when there is severe weakness in Cameco, I would definitely look at buying that. I'm sorry I can't be a little sexier or something like that, but I've just been in and out of some of these uranium deals for years, and I've never seen one of these juniors really find anything and go into production. Because remember, because uranium, because of the whole thing of being associated with nuclear, it's very tough to get the permitting and all that sort of stuff if you're not already in production. But yeah, I definitely think you may even want to look at some of the utilities as a play on it, because some of the utilities will start using nuclear, and if it increases their bottom line, that's kind of a conservative play on it as well. But I'm pretty long-term positive nuclear, because I think that the pure green plays like solar and wind are not overly economic.
Yeah, yeah, and they don't work if the sun isn't shining or the wind isn't blowing. Okay,
It,
battery metals, lithium. Lithium had one heck of a run and then basically just fell out of bed. What do you see anything in that market at all?
I think, like, again, I like the larger companies. There's a couple of plays in Chile. These are the large producers, pay large dividends. But the issue I have with lithium is twofold. Is I really am suspicious of the whole EV boom.
Yeah,
I don't think it's going to work. It's people want to be able to drive the car distances. These batteries have shown in some of these cold fronts that came through this year in Canada and the States, like they freeze, don't work in the cold weather. The costs are very high. I think the issue with lithium is it was definitely overhyped and overpumped in 2020 and 2021, especially as a stimulus after COVID, when they were trying to promote, all these green energies. So I've been a little suspicious of it. Now, with that said, it trades in China. It only trades in China, and it's gone from 600,000 won to 100,000. So it's off over 80% from its highs. Granted, they were inflated highs. So you might want to start look at some lithium deals here now, right? Because they're kind of due, the price is now at a more attractive level. One of the biggest ways to look at a bubble in mining and kind of gauge that you're near the top is, and all these guys in Vancouver, all these Vancouver promoters, we talked about this off air, when they start, changing themselves from base or, precious metals deals. In 2006, they did it in uranium. The last couple of years, they did it in lithium. In the late 90s, they went into tech. So when these guys in Vancouver start turning into the flavor of the day, you kind of have to watch out.
yeah,
So that's now there is a little junior I like called Argentina Lithium. It had a huge spike because they got a major, it's lit.v. They had a major investment from a company. So this is something that's actually had a major investment behind it. So yeah, you can look at something like that looks real, but be very, very, most of these lithium companies were just trying to catch on to it being the hot sector, and it kind of blew up in their face because now a lot of them are 5-cent garbage juniors with, a mediocre lithium, property.
yeah.
So yeah, I guess lithium I'm more neutral on, even at these levels, because I'm not a big believer that a lot of these green and EV type technologies are going to, be as large as people think. What's interesting though is a deal I've done really well. I won't talk about it because it's way too small to even talk about, but is actually using zinc battery technology. So that's another thing I would look at. Look at alternative batteries. And the interesting thing about zinc, it's only been around for about 10 years as an alternative battery technology. And what's interesting about it is it's not as flammable. There's way more zinc production in the world. You're not so dependent on China. So that's kind of an interesting thing. And that's battery storage. So I don't mind battery storage because you can use that for anything. Like you could have battery storage, even if you have a natural gas plant, so you don't burn off the excess natural gas. You can store it, right? And
Yeah.
then sell that when you have excess demand, when on the grid when the demand is high. So there's actually uses for that. So I much prefer actually some of these battery storage plays than just the lithium kind of miners. So I would say now, if you talked to me a year ago, I would have been super bearish lithium. Now I'm more neutral just because the price has come down a lot.
Okay. Okay. And so wrapping up here, what's your top uh, play commodity bet for 2024? What do you see doing the best?
I hate to sound like cliche, but I have to go with gold and silver because of what I showed you, what happens during the rate cut cycles. Now, 2 years ago when gold hit 2000 and we were entering the rate, hike cycle of, 2022, I wouldn't have said that. I would have said, gold's right near its high, especially when it spiked during the Russian invasion of Ukraine, where it was, when it went over 2000 then and has done nothing. But I would have to say, yeah, gold and precious metals, because again, when you get into this rate cut cycle, and I showed you 01, 02, and even 07 before everything crashed in 08, even if there's a bear market in stocks and there's a recession, during those rate cut cycles, gold and precious metals, especially the gold and precious metals equities and silver equities, etc., tend to be the strongest performing sector. And I'm not talking of the commodities, like they are the strongest performing sector, period, of the entire equity market. So yeah, I would have to say I like gold and silver at these levels, because also let's say you do get a mild recession or the economy kind of flattens out, something like copper is probably going to lag gold and silver here. So I would have to say yeah, gold and silver equities are kind of my favorite thing, other than isolated stocks. Like I actually have a few tech deals that I own right now that are all like 95 to 99% off their highs, I think are turnaround plays. So, but those are individual plays. Like as a sector,
Those are
again,
very specific bets. Yeah.
yeah, they're very specific bets. You're betting on management. Like I think longer term, you may think I'm nuts too. I think actually the cannabis stocks are now looking, attractive, because I
Okay.
think there's been more countries legalizing. I think people learn from the mistakes they made in the legalization in Canada. And these companies, again, are all 99%, off their highs. A lot of them are trading like below, price to sales below one. They're trading below their revenues. And a lot of them have cleaned up their balance sheets and stuff like that. So I think the cannabis sector, I know that Germany is going to legalize, I think at some point. I think you'll start seeing legalization talked about during the election campaign, because it's a way for politicians to try to get reelected. So I definitely think the cannabis sector, now that's again a big long-term play, not so much the short term. The one thing I like about the gold and precious metals equities here, I think that at this point is a 12 to 18 to 24-month play.
Okay. Awesome. Awesome. Well, thank you very much, David. If someone wanted to get a hold of you, what's the best way for them to do that?
Yeah. Again, so my email still, like I'm still transitioning everything to stock chart of the day, but it's just addicted to profits at hotmail.com. My name, David Skarica at gmail.com. I'm on Twitter. So if you want to DM me on Twitter, we could do that as well. So that's you could ask me some questions, and I said, like I said, I do have a Patreon, and also I do lifetime membership, especially if you're interested in kind of these private placements, your credit investor type deals. That's really what that service is for. But yeah, really, yeah, like I said, David at Skarica@gmail.com. And actually, if you become a lifetime member, I'm more than willing to give out my phone number on WhatsApp. And subscribers are always more than willing to ask me questions. Obviously, as long as they're respectful, don't take advantage of that. But yeah, that's really how to contact me. Those
Okay.
situations.
Awesome. Well, thank you very much, David. If you'd like to get a hold of David, his links will be down in the show notes below. Thank you for always being here, and thank you for tuning in. Hit the like and subscribe, and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.